Crypto Hotep here with another investing video. We are on week 14 of the Family Portfolio and Dividends Tracker. Thank you guys for tuning in as always. I really appreciate it. If this is your first time watching the video, feel free to go to the channel and first subscribe, hit that notification button, and then go to week number 1. We have made it past week 100. But go to week number 1 if this is your first time watching the video, and then that way you can get a taste and a background of what we're doing here with these weekly trackers. Basically, we set up each member of my family with a portfolio within M1 Finance, and it all encompasses a big family portfolio. And every week we go through this portfolio. We discuss the balances, any dividend activity, contributions that we have, and the overall market and how we're feeling. The purpose of the videos are just to track the investment journey start to finish with my family, hoping to build generational wealth and showing that it can build generational wealth even with small deposits. These aren't big deposits that we're making. It's just regular old quote-unquote pocket change that we're doing, and we've been doing this for over 100 weeks. So if this is not your first time watching the video and you've been down since week 1, I appreciate you, and please continue to share those videos and watch them and comment. Now, before we go to week 114, we're going to try to make this a very quick video here, and I'll see how the algorithm likes it. But before we go to week 114, we go to week 113, so the week prior, just to see where we were at. So week 113 saw our balance in the family portfolio at $4,465.01. That came out to a market gain of $194. with dividends earned of $32.52 and a money-weighted rate of return of 5.63%. Okay? So how did week 114 treat us here? Now, we've had a lot of stuff go on within this week here, and we've had the attacks on Iran again start up. So U.S. and Iran are going back and forth now again with the attacks. It's like never ending. So markets did not like that. Okay, so let's see what's going on here. So week 114 sees us with a balance of $4,415.03. So we did go down. That money weighted rate of return year to date is 3.99%. If we look at 1 year, the 1 year return is still above 10% at 16.21%. So again, when in doubt, zoom out. Okay, but we'd like to go with the year to date, see where we're at. And market gain is $129.22. Dividends earned is $32.52. So let's see what happened between this week and last week. Okay. So last week was a very quick week because it was the 4th of July. Okay, so we did have a couple buys here. So we did have a deposit on the 2nd, right? And then we did have some buys here on the 2nd as well. So we bought some QQQM. That was more than likely for every member of my family. And then we bought some SMH. And then we bought some SOXX or SOX. So these two are in my portfolio right here. Okay, but that's about it, right? So very quiet. It's not a contribution week for us. So that's all that's happened. We didn't have any dividends either. So let's quickly go through the portfolio bottom to top as we always do. At the bottom, unfortunately, my wife. My wife's portfolio balance is $628.62, money weighted rate of return of a negative 3.63%, market gain of negative $27.05, dividends earned of $4.89. So here, again, with my wife's portfolio, it's very easy. QQQ, XLY for consumer discretionary, and then FSTA for consumer staples. Okay. Again, with the market dipping because of the uncertainty with the Middle East conflict, that reflected on tech stocks heavily. Okay, so tech stocks are at, I would probably say they're almost at their cheapest that they've been in a while. So when stuff is cheap, that means your portfolio is potentially going down. So right now, we are down in XLY, consumer discretionary, and tech stocks, some of the most highly volatile things. Consumer staples, that's more of the quote unquote safe investments as of right now. So consumer staples, those long standing, kind of boring companies, if you will. So that's where those consumer staples come into play. Okay. So you can see where that money's rotating out of. It's more risk off assets versus the risk on assets. So let's go to our youngest. Our youngest has a balance of $659.72. Money weighted rate of return of 5.41%. Market gain of $27.70. Dividends earned of $4.10. Again, we have QQQ there. We got XLY, FSTA, and then we have some video games. So ironically, video gaming has gone up substantially. So video gaming, the video gaming ETF, ESPO or ESPO, is up year to date 3.73%. What's funny is in the video gaming industry, Microsoft has slashed jobs dramatically. They fired or laid off over 4,000 people this past week, majority of them coming from the Xbox division. Okay, so I don't know if that was seen as bullish. Potentially it was, because normally, if you're laying off from a company perspective, that means you're tightening the belt and really combing through your budget. So that's usually seen as a bullish sign for stocks. So that could have translated over to this. Let's go to our middle. Our middle has a balance of $669.67. Money weighted rate of return of 12.59%. Market gain of $64.78. Dividends earned of $5.30. Again, similar QQQ, but this consumer discretionary, we have VCR, so Vanguard Consumer Discretionary, Fidelity, FSTA, and then ESPO again. Okay, so you can see here, we still have the consumer staples in the green. We still have the video gaming in the green. And then this Vanguard Consumer Discretionary is still in the green as well, but QQ is still bleeding out. Okay. Let's go to our oldest. Our oldest has a balance of $1,226.96. Money weighted rate of return year to date of almost 5%, 4.99%. Dividends earned $8.19. Market gain of $48.40. Similar to my wife's QQQ, XLY, FSTA here. Make it real easy. Okay, so nothing there. And then last but not least, my portfolio. Again, guys, my portfolio is heavily invested into chips and quantum computing. My balance is $1,230.06. Money weighted rate of return year to date of 2.19%. Dividends earned of $10.04. So as I just mentioned, we bought some stocks, we bought some SMH. They are in the green right now. These have been some of the most volatile positions I've ever held in M1 Finance if I wasn't trading. So investment wise, these are some of the most volatile assets that I've held here. Also, cloud computing is getting an uptick here. And then we have cybersecurity pushing up over 9% year to date for cybersecurity. Okay. And then quantum is down almost 1%. Not really worried about quantum. All in all, that's a very good portfolio for me. I feel good about this. And again, your first time watching this video, we've come a long way since week one. We transitioned our family's portfolio of individual stocks to ETFs for the sake of simplicity and for the sake of less stress and just an easy kind of cruise control way of generating wealth. Okay, So one thing I do want to go into really quickly before we shut the video down here for week 114 is as I mentioned, the reason for that ETF, the ETF way of investing, again, is because of the simplicity. And this is what I mean here. So one of the funds that most of my family invests into is that Consumer Staples Index ETF, the ticker symbol FSTA from Fidelity. Okay, and the reason for that is because it makes it very easy to hold multiple companies in one asset. So if you're not familiar with ETFs, ETF stands for exchange traded funds. And this fund in particular holds 98 holdings. Okay, so it has 98 companies that are from the consumer staple sector, right? Almost like consumer defensive. So it's more on the defensive side. So when the economy drops down, usually this piece will help your portfolio up. So here are your top 25 holdings here. So within this one ETF, the top 25 holdings are names like Walmart, Costco, Procter & Gamble, Coca-Cola, Pepsi, Altria, Colgate, Target, Dollar General, Hershey, Kroger, Cisco. So very well established and, again, boring names that don't have a lot of volatility. And so you need that defensive piece in your portfolio because everything's not going to go up in tech all the time. So you need that you got to play a perfect balance of having that. And that's what this Consumer Staples Index does accomplish. And again, this is one of the reasons why we moved over to this, because instead of picking, say, Walmart, for instance, which is still a safe, quote unquote, safe bet, and sticking with Walmart as an individual stock, well, what if Walmart has a bad year, right? What if something happens with Walmart and for maybe a year, 2 years straight, it's just bleeding out and the stock is just tanking? Well, that'll bring your whole portfolio down. Whereas if Walmart, and I know it's a big chunk of this ETF, but say for instance it is underperforming, Fidelity for FSTA may do some allocation adjustments or percentage adjustments for their holdings. This is something you don't have to do, you don't have to worry about. And another thing, other than the allocation, is all the rest of these companies will help make up maybe the shortcomings of Walmart. And again, you don't have to do that either. So it takes the guesswork out of investing, and it puts it again on semi-cruise control here. So for week 114, guys, we're going to close it out. And hey, we're not even at 14 minutes. We're getting better with this. The family portfolio has a balance of $4,415.03, money weighted rate of return of 3.99%, market gain of $129.22, and dividends earned of $32.52. If this video was helpful, guys, and you like keeping up with this journey and this investing journey with me and my family, please like the video, comment on it, let me know what ETFs you're investing in, and if you like individual stocks versus ETFs, and most importantly, subscribe. And as always, guys, thank you and happy investing.